It's important you hear this before you file your 2026 taxes, because the IRS has quietly made several changes that most seniors will not notice until it's too late, and by then, the damage is already done. Some retirees could end up paying more than they should, while others may miss out on money they are legally entitled to receive, simply because they didn't understand these updates in time. And here's what makes this even more serious. Most of these rules are not being clearly explained in plain language, which means many people over 60 are walking straight into costly mistakes without realizing it. Stay with me because in a moment I'm going to break down what's really changing and why so many retirees could be affected this year. But first, you need to understand something critical. The IRS system is becoming more automated, more data-driven, and less forgiving when errors happen. That means even small mistakes on your return can trigger delays, reduced refunds, or unexpected tax bills that catch people off guard. Most retirees don't realize how much their income sources now overlap in the eyes of the IRS. Social Security, pensions, retirement account withdrawals, and even part-time work are all being cross-checked more closely than ever before. And this is where many seniors make a mistake without even knowing it. They assume their tax situation is the same as last year, but the rules tied to reporting income and deductions have been quietly adjusted. Here's where it gets interesting. One of the biggest hidden changes affecting seniors in 2026 is how certain retirement income thresholds are being evaluated. In the past, many people believed their Social Security benefits were only partially taxed under simple income formulas. But now, the IRS is tightening how combined income is calculated, which can push more retirees into taxable territory without any increase in their actual lifestyle income. That means you could be paying taxes on benefits you previously assumed were protected, but that's not even the biggest surprise. Very few people know this yet, but the way deductions are being verified has also become stricter. The IRS is relying more on automated matching systems, which means if there is even a small mismatch between what your bank, your retirement account provider, and your tax return report, it can trigger a review. And once that review starts, refunds can be delayed for weeks or even months. What happens next may shock you. Some seniors think that if they simply report everything honestly, they are completely safe. But the reality is, honest reporting is not enough if the timing or classification of income is slightly off. For example, a retirement withdrawal taken at the end of the year might be processed differently than one taken at the beginning of the year, and that difference can affect how much tax you owe. And this is exactly why the IRS update for 2026 is so important. It is not just about new tax rates or new forms. It is about how your information is being analyzed behind the scenes. The system is becoming more precise, which is good in theory, but it also means fewer chances for manual correction once something is flagged. Stay with me, because in the next part, I'm going to explain one of the most overlooked IRS rules that can quietly reduce your refund without any warning. And most seniors only discover it when it's already too late to fix. This is where many retirees start to feel confused, because on the surface, nothing about filing your taxes in 2026 looks dramatically different. Yet behind the scenes, the IRS has been quietly tightening how certain forms and income entries are reviewed. And most seniors over 60 won't even notice until something unexpected happens, like a smaller refund than last year, or a delay that nobody can clearly explain. Very few people know this, but one of the most important shifts involves how retirement income is verified against third-party records. In the past, there was often a delay between what you reported and what financial institutions reported to the IRS. That gap sometimes allowed small inconsistencies to go unnoticed or be corrected later without serious impact. Now that gap is shrinking fast. The IRS systems are increasingly matching your reported income in near real time, which means even minor differences can trigger automatic adjustments. Here's where it gets interesting. Many seniors assume that if their tax software accepts the return, everything must be correct. But that's not always true anymore. The IRS is increasingly making post-filing corrections based on its own internal data matches. So even after you file, your return can be adjusted without a traditional audit. Most retirees don't realize this is happening until they receive a notice explaining a change in their refund amount. And this is where many seniors make a mistake. They overlook small forms that seem unimportant, like 1099-R updates, corrected brokerage statements, or revised Social Security benefit summaries. But these documents now play a much bigger role in how your final tax outcome is calculated. A small correction on any of these can change your taxable income, which then affects credits, deductions, and sometimes even Medicare-related premium calculations. Stay with me, because in a moment I'm going to reveal something even more important. There is a lesser-known IRS review process that doesn't look like an audit at first, but can still slow down your refund significantly. And what makes it worse is that most seniors never receive a clear explanation for why it happens. But before that, you need to understand another key shift. The IRS is placing more attention on timing differences in retirement withdrawals. It may sound simple, but when you take money out of a retirement account can now affect how it is categorized. For example, withdrawals taken late in the year can sometimes be processed in a different reporting cycle, which can create mismatches between reported income and verified income records. This is especially important for seniors who rely on multiple income sources. If you have Social Security benefits, a pension, and even small investment withdrawals, the IRS is now evaluating the combined pattern of your income more closely than ever. And this combined view is what often leads to unexpected adjustments. Here's what happens next in many cases. A retiree files their return, everything seems normal, and then weeks later a system flag is triggered because one income source was updated after filing. That update then forces a recalculation of the entire return. And in some cases, this results in delayed refunds or reduced credits that were initially expected. Most retirees don't realize how interconnected these systems have become. What used to be separate income streams are now being analyzed together as one financial picture. And that is exactly why small reporting differences matter more than ever in 2026. Stay with me, because in the next part I'm going to break down a hidden IRS rule that can quietly reduce certain senior deductions without any obvious warning signs, and this is one of the most overlooked areas in retirement tax filing right now. This is where things start to get even more important for retirees, because one of the least understood changes in the 2026 IRS filing environment is how deductions are being reviewed more strictly than before, especially for people over 60 who rely on retirement income and medical-related expenses to reduce their taxable amount. Most seniors don't realize this, but deductions that were commonly accepted in past years are now being checked more carefully through automated validation systems. And here's what makes this tricky. Nothing about the tax form itself clearly warns you that the interpretation behind the scenes has changed. So people often file the same way they always have, assuming nothing has shifted, and that's where unexpected adjustments begin to appear. Stay with me because this is where many retirees make a silent mistake. Certain deductions tied to medical expenses, retirement planning fees, and even some itemized costs are now being cross-checked against income thresholds more aggressively. That means even if you qualify on paper, the IRS systems may still reevaluate how much of that deduction actually applies based on updated income calculations. Very few people know this, but the IRS is also paying closer attention to how deductions interact with Social Security taxation rules. In some cases, a deduction that reduces your taxable income might also indirectly affect how much of your Social Security becomes taxable. And that interaction is not always obvious when you file, especially if you are using standard software that doesn't fully explain the downstream effects. Here's where it gets interesting. Some retirees believe that once a deduction is entered, it automatically lowers their tax bill in a predictable way. But in reality, the IRS system now recalculates eligibility in layers. First it looks at income verification, then it adjusts deductions, and then it reevaluates credits. If anything shifts in one layer, it can ripple through the others. But that's not even the biggest surprise. There is also increased scrutiny on raw retirement account withdrawals that are labeled as regular income distributions. If those distributions change in timing or amount compared to previous years, the system may treat them differently when calculating allowable deductions tied to income limits. And most seniors are never notified in advance that this kind of recalculation is happening. What happens next may surprise you. Some retirees end up seeing smaller than expected refunds, not because they made a mistake, but because a deduction they expected to apply was partially reduced during IRS processing. And the frustrating part is that the explanation often comes after the refund has already been adjusted. This is why understanding how deductions are being interpreted in 2026 is so important. It's no longer just about entering the correct numbers. It's about understanding how those numbers interact with the IRS's updated matching and recalculation systems. Stay with me, because in the next part, I'm going to reveal a hidden IRS trigger that can cause delays even when everything on your return is completely accurate. And this is something that catches a lot of seniors off guard every single filing season. This is where the situation becomes even more frustrating for many retirees. Because even when everything is filled out correctly, delays can still happen without any obvious mistake on your part. And that's exactly what's been confusing so many seniors in recent filing seasons. Very few people know this, but the IRS now uses more automated review filters that don't always look for errors in the traditional sense. Instead, they look for patterns that require additional verification. That means your return can be perfectly accurate, but still get paused, simply because something in your financial pattern looks different compared to previous years. Stay with me, because this is where many seniors make a mistake in thinking that delays always mean they did something wrong. That's not always true anymore. In many cases, delays are triggered by system checks that are designed to confirm identity consistency, income stability, or changes in retirement distribution behavior. And these checks can happen even if your tax return is clean and complete. Here's where it gets interesting. One of the biggest hidden triggers for delay is a sudden change in reported income sources. For example, if a retiree had steady pension and Social Security income for years, but suddenly adds or changes a small part-time income or adjusts withdrawal amounts from a retirement account, the system may flag it for review. Not as an audit, but as a precautionary verification step. And this is something most seniors don't realize. These verification steps don't always come with immediate notice. Sometimes your return just sits in processing longer than expected, and the reason only becomes clear later, when a letter arrives, or when your refund timeline is extended without explanation. But that's not even the biggest surprise. There are also cases where duplicate reporting between financial institutions can create temporary mismatches. Even if the error is not yours, the IRS systems may pause processing until the mismatch is resolved. And during that time, refunds can be delayed significantly. What happens next often catches retirees off guard. They assume calling the IRS will quickly fix the issue, but in many cases, the system has to complete its own verification cycle before any manual correction can take effect. This means even simple issues can take longer to resolve than expected, especially during peak filing periods. Most retirees don't realize how sensitive these systems have become. A small change in account reporting, a revised form from a bank, or even a corrected brokerage statement can all trigger a temporary hold. And while none of this necessarily increases your taxes, it can still delay access to your refund or final tax outcome. This is why understanding these hidden triggers is so important in 2026. It's not just about accuracy anymore. It's about how your financial data is interpreted across multiple systems at the same time. Stay with me, because in the next part, I'm going to break down one of the most overlooked IRS updates that can quietly affect seniors' refunds and even retirement income calculations without most people noticing until it's already happened. This is the part most retirees don't expect, because it doesn't feel like a rule change at first. It feels more like a behind-the-scenes adjustment that quietly affects how your final tax result is calculated. And the problem is, by the time seniors notice it, the return has often already been processed. Very few people know this, but the IRS has been placing more emphasis on what they call data consistency between reporting institutions. That means your bank, your retirement plan provider, your brokerage account, and even Social Security records are expected to align closely with what you report on your tax return. And when they don't match perfectly, even in small ways, the system doesn't ignore it anymore. Stay with me because this is where many seniors make a mistake. They assume that small differences don't matter. A few dollars here or there, a corrected form, or a slightly updated 1099 is usually seen as harmless. But now, those small differences can influence how the entire return is processed, especially when multiple income sources are involved. Here's where it gets interesting. One of the most overlooked IRS updates is how corrected financial documents are treated after you've already filed. In the past, if a corrected form came in later, it often resulted in a simple adjustment or minor notice. Now, those corrections can sometimes trigger a full recalculation of your return, even if the change is very small. And that recalculation can affect not just your tax amount, but also credits and deductions tied to your income level. But that's not even the biggest surprise. Some retirees are now seeing situations where their refund estimates change after filing, not because they made a mistake, but because third-party reporting data was updated after submission. This creates a mismatch between what you thought you filed and what the IRS system eventually confirms as the final version of your financial data. What happens next may shock you. In some cases, seniors receive a refund that is lower than expected, without any clear warning beforehand. And the explanation often refers to adjusted information reporting, which can sound vague and confusing if you're not familiar with how these systems interact. This is exactly why so many retirees feel caught off guard during tax season, even when they believe they did everything correctly. Most retirees don't realize that the IRS is no longer just processing returns as isolated documents. It is now treating them as part of a larger, continuously updated financial profile. That means your return is influenced not just by what you submit, but also by what other institutions report before and after you file. Stay with me because this is important. This shift also means timing matters more than ever. If a financial institution sends corrected data after you've already submitted your return, it can still change the outcome. And many seniors don't realize this is happening until they receive a notice weeks later. And here's the part that really surprises people. Even small timing differences in retirement withdrawals or end-of-year distributions can now have a bigger impact on how your income is categorized. That can influence not only taxes owed, but also how certain benefits or thresholds are applied in your overall financial profile. This is why 2026 feels different for so many retirees. It's not that the tax rules are suddenly impossible to understand. It's that the system is now more interconnected, and those connections are what create unexpected results when information updates don't align perfectly. Stay with me, because in the final part I'm going to bring everything together and show you the most important takeaway seniors need to understand before filing, so you can avoid these hidden issues and protect your refund as much as possible. This is where everything comes together, because once you understand how these hidden IRS changes work in 2026, the most important thing is knowing how to avoid the situations that catch so many retirees off guard every year. And if you've been following along, you already see the pattern. It's not one single rule causing problems, it's how multiple small updates interact behind the scenes. Most retirees don't realize that the biggest risk now isn't necessarily paying higher taxes by mistake. It's the timing and consistency of information flowing between different financial systems. That means your Social Security records, retirement withdrawals, bank reporting, and brokerage statements all have to align closely, or the IRS systems may automatically adjust your return without warning. Here's where it gets interesting. The IRS is increasingly relying on automated matching instead of manual review. That means fewer human corrections and more system-driven adjustments. And while that sounds efficient, it also means there is less flexibility when small mismatches appear. Even something as simple as a corrected 1099 after you've already filed can change your final outcome. Very few people know this, but one of the most important things seniors can do is pay attention to updates even after filing. Most people assume the process ends when the return is submitted, but in reality, your tax profile continues to be updated as new information arrives. And those updates can still affect refunds, credits, or final tax calculations weeks later. Stay with me, because this is the key takeaway. Many of the issues seniors face are not caused by major errors, but by small timing differences and data updates that happen after filing. That is why reviewing your financial documents carefully before submitting is more important than ever. And making sure everything is consistent across all income sources can help reduce unexpected adjustments later. What happens next is something a lot of retirees only learn the hard way. They assume delays or changes means something went wrong with their filing, but often it's just the system reconciling updated information. Understanding this can reduce a lot of stress during tax season, because not every notice or delay means a serious problem. But that's not even the most important part. The real takeaway is that 2026 tax filing is becoming more about awareness than complexity. If you understand how your income is being reported and matched, you are far less likely to experience surprises. Most seniors who stay organized with their documents, double-check their forms, and avoid rushing through filing are the ones who have the smoothest experience. So as you go into this filing season, remember this. Small details matter more than ever, timing matters more than ever, and consistency across your financial records is the key to avoiding unnecessary delays or adjustments. If you take your time and stay informed, you can protect yourself from most of the common issues that are affecting retirees this year. If this helped you understand what's really changing, make sure to like the video so more seniors can see this important update, share it with someone who is preparing to file, and subscribe for more clear, honest breakdowns about Social Security, IRS updates, Medicare changes, and retirement benefits. And as always, stay informed, stay prepared, and take care as you move through this tax season.